Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax policy to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in PwC's Policy on Demand studio in Washington, D.C., where I'm thrilled to have Professor Itai Grinberg on the podcast. Itai is a professor at Georgetown University Law Center and served as Deputy Assistant Secretary of the United States Treasury Department during the Biden administration, where he served as lead U.S. negotiator for the global corporate minimum tax. Itai, welcome back, sort of, to the podcast.
Thanks for having me, Doug. Glad we're doing this again.
Yes, and we'll explain that. But before we begin, an important caveat. All of the views expressed by Professor Grinberg do not necessarily reflect the views of PwC. All views are his own.
Agreed.
All right. I also wanted to mention for the audience, Itai, that we attempted to record this a couple months back in front of your students. And I think we had a fantastic discussion, your perspective of the Pillar 2 origin story. The discussion was great. The audio was not. So I very much appreciate you coming in to re-record this episode in this studio. And I think this is important, what we're talking about. As you know, we had Pascal Saint-Amand. I had Pascal Saint-Amand on the podcast a couple years back. And I really think that your perspective is a crucial piece to the Pillar 2 origin story, particularly as the primary representative from the Biden administration. So thank you for coming back for this second recording. All right, so before we dive in, I'm going to ask you the same question that I did in front of your students. It's going to lose a little bit of its luster here, but what is your elevator speech, Itai, as to why students should consider international tax as a profession?
I mean, what I tell them is if you want an incredibly complicated puzzle that'll give you a marketable skill that also touches every cross-border transaction, then maybe this is the subject for you.
Yeah.
And that's my story.
I recently did drinks with one of my best friends from law school, and we were kind of reflecting on 25 plus years in our careers. And he practices in a much more narrow area. He does litigation, and he's a true expert in his field, but it's not very dynamic. You know, it's just like, rarely do they get a case that would change the law or there's something new that comes out. And it really made me appreciate the fact of and he was a little envious of just like how dynamic it is. And it's just constantly changing. You're having to stay up to date. Obviously, I've had a chance to travel the world and work with people from all their cultures. But it really made me appreciate like how much I still love my job, how dynamic it is, how I'm challenged every day, how there's never a shortage of new things.
And there's everything from knotty technical problems to big geo-economic questions. And so it's great.
Absolutely.
Yeah.
Okay, so we're going to dive into Pillar 2, but what I want to start with a timeline, just to provide a little bit of context for the listeners and so that they can understand sort of where you came in the process. We're going to go all the way back to 2013. The G20 and the OECD Base Erosion and Profit Shifting, otherwise known as BEPS initiative, was formally initiated by the OECD's Committee of Fiscal Affairs. Over the next 2 years, 15 action items were developed, including Action 3, strengthening the CFC regime. The Inclusive Framework was established in 2016, recruiting additional countries into what became the Pillar 1 and Pillar 2 project. In October 2020, near the end of the first Trump administration, the OECD released its report on Pillar 2 blueprint. And then in February of 2021, so a few months later, you joined US Treasury for the Biden administration as Deputy Assistant Secretary. And then in December of 2021, so later that year, the Pillar 2 model rules were released. So let's start with, how did you get this gig?
Right.
Itai, like, how did you get the job?
I know, and you have to rewind all the way to November 2020 to understand that.
Okay.
So Joe Biden has won the presidency. Democrats control the House and the Senate, barely. President Biden's campaign platform importantly included moving GILTI to a country-by-country system. and raising the GILTI rate and raising the corporate rate. Meanwhile, I'm historically someone that Republicans call as a witness. So how'd I end up with this job, right? I've said going to worldwide by ourselves is not wise when other countries are in dividend exemption. But the thing is, I'm also like a never-Trumper. I'd called the right people in the Biden campaign in the summer of 2020, and I tried to explain to them that if the US were to go country by country on GILTI, then clearly as a competitiveness matter, we really want the rest of the world to come along with us, and that something like that was already being negotiated at the OECD. So I go off my merry way, but it turns out the Biden campaign policy team didn't know that much about the OECD process. They appreciated my calls and briefing. And then in November, Donald Trump does something unusual, which is he disputes the results of the 2020 election, and as part of that, he refuses to give security clearances to the Biden team to let the winning side go talk to the civil service, go talk to the Treasury to start transition. And amazingly, the Biden team has a contingency plan for this. And they had actually decided in advance that if Trump blocked their access to the civil service, they'd call a list of like a couple hundred people they had who weren't necessarily Democratic blue bloods, but who they thought were experts on like specific issues where they thought they needed immediate input. And they would ask those people to join the transition. Turns out I'm on that list. So I get a phone call like a week after the election. And like almost everyone who gets this call that says the country needs you, literally because Trump won't let us go talk to the government, I say yes.
And you were a professor at Georgetown.
I was professor at Georgetown at the time, yeah. And I start working in mid-November with a mandate to think about all of international tax, but to develop policy focused on how the Biden administration should deal with the two pillars, with the clear understanding that Biden campaign positions, including like the idea that, you know, GILTI should go country by country and corporate rates should go up. Those obviously are like, those are decided. That's done. So that's the story. That's how I got the gig.
And so when you started then, what was your role in the Biden administration, and really interested in when and how you started focusing on the pillars and specifically Pillar 2. And we're not going to spend a lot of time on Pillar 1. I think that's dead for...
Basically dead, yeah.
I don't even
dead
think it's
done.
basically.
Yeah.
But people are still talking about it. But, you know, Pillar 2 is here, and we're going to get your thoughts as to what the future of it is. But we've got companies and practitioners that are getting ready. Compliance is around the corner. So what was your role in the Biden administration, and when did you start focusing on Pillar 2?
Right, so I'm focusing on it from late November after the election. And it starts out with me intensively briefing the global minimum tax and Pillar 1, and ultimately I'm briefing Secretary Yellen. But then importantly, she decides that I have to start briefing other parts of the government. And so I end up briefing, you know, National Security Advisor Sullivan, Director of NEC Brian Deese, Commerce Secretary Raimondo, USTR Secretary Itai, the State Department in utero, all of those people before inauguration.
Okay.
Which, to be clear, is like unheard of for a tax policy project, right? And so we really should figure out why that happened. And why it happens, and it becomes clear to me, because I start out with this level playing field perspective, right? Which I've come to from 20 years of basically believing in that and having the private sector tell me that's a good thing. But as we start walking through it, it turns out that for Jake Sullivan, for the State Department, for Secretary Yellen, the OECD negotiations are attractive for reasons well beyond international tax. A basic problem the Biden team has is that Donald Trump in his first term has seriously compromised economic relationships with our allies, often by treating them no better than and sometimes worse than our adversaries. And that's created blowback. And so the administration wants an international economic policy to rebuild relationships, including with Europe and with Japan and with Canada. But the thing is, the administration is split internally between those who, setting aside China, are pro-free and open trade, and those who have a more protectionist bent. So the administration, they can't commit to new free trade agreements or greater market access, or even actually agree internally to drop all the first-term Trump tariffs or restore the functioning of the WTO. None of that. And remember, this is like before the Ukraine war. So the day-to-day cooperation internationally is mostly around economics, right? That's how people think about it. And so I'm articulating that the global minimum tax is a policy that's consistent with Biden campaign proposals. Everyone's on board with that. It's supposed to reduce tax avoidance and inversion risk and level the playing field for US M&Es. And remember, the Biden team wants and thinks it will soon have its way, that M&Es will soon face country-by-country GILTI. So that argument, is meaningful. But meanwhile, from the perspective of all these other people, actually, Pillar 2 goes well beyond that. It's a path to help rebuild and revitalize our economic relationships with allies while sidestepping the internal fight about protectionism versus free trade. So, I'm sitting here saying, okay, I was an associate at Skadden in the policy shop in part, right? And I wrote reports about the level playing field. I mean, I came to these beliefs honestly, right? And for NFTC, for TCPI, for the Chamber, for the predecessors of ACT, like the level playing field, that was basically the #1 private sector talking point for 20 years. Like literally all the way until it was delivered.
Yeah, we saw a lot with like the inversions, and then we had, the Tax Cuts and Jobs Act came out, and obviously there were a series of regulations that sort of ended some of the inversions. That's where U.S. parented groups would become parented by another territory. And then we had the Tax Cuts and Jobs Act, which, Pascal even admitted or commented that GILTI was the first income inclusion rule of its type, right?
Sure.
That the income inclusion rule was really designed around GILTI, but it was not country by country, right? And then the rate was 21. And so I do think it's an important point for listeners to understand that sort of the premise when you took the job was that we're going to move to a 28% corporate rate, right? And then GILTI is going to be country by country. And one could argue that that was a reasonable thought because Biden had Democrats in both the House and the Senate. And so the thought was that there were 2 years that they could get those legislative changes.
And even if you believed that 28 wasn't reasonable, 25 was like very serious. People were taking it very seriously, all the way through September when the House bill doesn't have it, right? But I think, the other thing to recognize, right, is, like the OECD thing is a foreign initiative that can help build support for this domestic legislative proposal. So NEC likes it, okay? And it even turns out that it solves USTR Catherine Tai's predicament, which is basically that Bob Lighthizer left her with a report that said digital services taxes are discriminatory, but he didn't actually put on the related tariffs, right? He threatened them but didn't put them on. And the truth is Catherine Tai doesn't mind tariffs at all, but it turns out she had no real interest in levying tariffs to defend big tech. And now this project says, I can talk about this Pillar 1 thing. I don't have to levy tariffs to defend big tech, and I can still say I'm doing something, okay? And Secretary Yellen, she sees all the pieces. She sees the corporate international tax story, right? She sees the domestic legislative story. She sees the trade story. She sees the economic relationship story. And so she ultimately asks me to go around briefing. I ended up briefing 6 cabinet level designees pre-inauguration. And that's eventually why I end up with this, we end up with an all-of-government mandate for Pillar 2, not just a Treasury mandate, and a sort of unique role for me, in truth.
Oh, yeah. And it's fascinating. I think that really probably was some of the start of it, of just how big, international tax now is in the news. We used to hide in our little corner of tax and specialty, and obviously with the most recent, Trump day one executive order on international tax, we're really front and center. Maybe you can tell me about, I know you took an overseas trip with Secretary Yellen and had the opportunity, I think, to debrief and meet with a number of foreign ministers over in Europe. Tell me a little bit, if you can, tell me a little bit about that anecdote. And I'm interested in sort of your relationship as you were working with other members of the Inclusive Framework and specifically Europe. And how did we kind of move, because we ultimately, at the end of December, we had the model rules came out. I'm interested in kind of how we got from the Biden administration coming in to those model rules coming out at the end of 2021.
Yeah, and it's important to think about it in terms of period, right? So you've got the pre-inauguration period, which we already talked about. And then you've got this period from January till the G7 finance ministers meeting in June, which is what you're asking about, right? Yep. And so, that meeting, okay, is really interesting because it's the first time that I go abroad with Secretary Yellen. I don't know at the time that I'll be going with her abroad every time she goes abroad for the next 18 months. I don't know that's happening.
Okay, this is the first trip.
Yeah, this is the first trip. Basically, first on the trip, understand we've been negotiating now for Pillar 2 for a while. Okay, so there is a term sheet. Okay, and the briefing on the plane is going line by line through the term sheet. And I got to tell you, Janet Yellen I mean, you can't ask for more from a boss. Like the way she prepares, the way she asks questions, like it was honor in my life to work for her just because she's so smart and she just keeps probing, right? She asked about the UTPR. She asked about Pillar 1. She asked about all of these dynamics, right? But the reality is that where we are at that point is that she's been talking about a global minimum tax. And meanwhile, what happens is that in the United States, the American Rescue Plan passes. So the Biden administration gets its big infrastructure and child tax credit and all that policy through.
That was the first big bill.
That's the first big bill. And so we've been having these internal negotiations inside the administration, and NEC, which is quite progressive, has come back, right? And they're now really engaged, and they're pretty sure we're going to pass another bill with everything the administration wants, right?
A tax bill.
Build Back Better, which in the end doesn't pass,
We're
right?
gonna come back
we'll
to
get there,
that.
and so like at some point along the line, we've had a discussion internally with the White House where basically they say, well, okay, I mean, there's a fight about it. Well, you guys can keep pursuing this, but it has to be at least 15%, okay? And at this point, then the secretary starts saying it, and I start saying it in April and in May because we end up with an agreement with the White House. That's what we're going to do. And we get the French finance minister to say it before the G7 meeting, and we get the German finance minister to say it. They're even saying 21 at one point. And Canada's
as far as
on
the
board.
minimum tax.
As the minimum tax, they're asking for 21. They know what we want. And Canada's on board and Japan's on board, but Sunak's not. Okay, and you have Mike Williams, who's the head of the UK's international tax function, and he's been throwing cold water on Pillar 2 pretty much the whole time, right? And he's doing that like for a reason, right? Which is, first of all, he's afraid that the U.S. won't pass a bill. Second of all, like, you got to realize, like, the period we're in is a period where everyone is thinking about Brexit, because Brexit's just happened. Right. Like, Brexit's still totally fresh, and we're still in the period where then Prime Minister Johnson is saying, well, what we want is to have the lowest corporate tax rate in the G7, and we want to get companies basically to relocate here, to invert here, right?
And
I mean, it was what people called Singapore on Thames, right? Yeah. Like, that was the buzzword for it.
Okay.
And so that's really focused a lot of minds, especially in Europe. And meanwhile, Mike Williams, what does he think? Well, he kind of thinks, look, I mean, I was against Brexit, but now that we've done Brexit, I sort of think that our best chance is actually to get all this redomiciliation. So I'm sort of against Pillar 2. But meanwhile, my chancellor, he's not totally there. So what am I doing? I'm saying things like, okay, well, we can agree to Pillar. I'm getting the chance. I mean, literally, I'm getting Chancellor Sunak to go on British TV and say things like, "We support Pillar 2, but only if it's with Pillar 1."
Who is saying this? Is this Mike's perspective or
this
your
is
perspective?
Mike's perspective, and he literally gets. I mean, the week before we go to this G7 meeting, he gets Chancellor Sunak to go on British TV and say, "We support the global minimum tax, but only in tandem with a Pillar 1 deal, which also is a treaty for everything, for both of them." Now, let me ask you, Doug. Could you get a treaty for both Pillar 1 and Pillar 2 through the Senate with 2/3? I know you're a magician, right?
Yeah. No.
Yeah. So you can understand Mike knows that that's impossible. Right. Sunak might not, okay? We have to have a meeting with Sunak, and that's the meeting we prepped for. We have to have like a multi-hour, the first meeting I have when we show up in London is basically a multi-hour meeting with Chancellor Sunak in which we debate all this stuff. And at the end, like, Sunak comes on board, okay? And so now, we have agreement for the first time, right? And meanwhile, of course, at the OECD meetings, there's been all this stuff that Mike has been saying before this, right? Things with Mike saying things like, okay, how confident are you that the US will go guilty country by country, right? And what do you think my job is? My job is to say all the things, right?
Yeah, well, what did you say? What was the answer to that?
The answer is the Biden administration is committed country by country and confident in its reform efforts. What are you supposed to say? And let's be clear. I mean, it's not like you could say something else, right? Because those meetings, they're not confidential. Like, it's not like you can say something there and it doesn't leak, right? Like, it doesn't matter what you believe. Like, if you say anything else, it's going to affect the domestic legislative process and you're going to get fired. Like, just to be clear, right? It's 100% clear what I need to say, right? And so I say it. And Mike, of course, he doesn't say that he's against the minimum tax, but he doesn't say that. He says there should be a treaty that links the two. You see what I'm saying?
Yeah.
Like, which is just a way of fighting it without saying I'm against it because my chancellor is not so against it. So I'm going to come up with something meaty, right? Like,
politics are complicated.
Yeah, politics are complicated. But anyway, basically,
So you're able
we
to
get this deal, and now that we have the deal at the London G7, which is, I mean, basically we spend most of that meeting, like the primary subject that the G7 finance ministers and their tax leads spend that 2-day meeting on is Pillar 1 and Pillar 2. That is the only subject of discussion where the finance ministers have one meeting, and then they send all their negotiators out, and they have their negotiators come back in and brief the ministers, and they have another discussion, and then they're fighting about the paragraphs in the communique to the very end of the meeting, like it's the final thing to be finalized. It is the subject of the meeting, okay?
Which is remarkable,
Which is
right?
amazing.
That
It's
international
amazing.
tax
Yeah.
was like this important.
This important.
This is exactly why I want to have this
And
conversation.
importantly, like when it's over, okay, it's really interesting. Like, what do we get? Well, we get a communique that commits the G7 to push for Pillar 2 at a 15% rate. We never had that before. All G7 countries are agreeing on a country-by-country basis. Okay, it says, look, there's no timetable for Pillar 1 that's the same as Pillar 2. It doesn't agree that DSTs are kosher if we miss the deadline, which the UK wanted. It doesn't link Pillar 2 and Pillar 1. It includes a commitment to get rid of all DSTs if Pillar 1 gets done, right? And then the press conference, what does Yellen come out and say? She talks about rebuilding international economic cooperation via international tax after the Trump years, as well as stopping tax avoidance and all of that, right? And Sunak, he basically says the same thing, okay? But now we've made front page news, okay? And now we have a G7 agreement. And so there's two things going on. First of all, I think that the private sector was shocked that we'd gone this far. The Biden administration was shocked too, okay?
Yeah. I remember being shocked as a practitioner.
So it's important to realize, like from Jake Sullivan's perspective originally, right, from the NSC's perspective originally, the whole point was, it was great if you got it, but the most important thing was just to be leading the discussion. Trying to lead a discussion about international economic cooperation was the most important thing. But now we've gotten it, and now it looks like it could be like this big victory for the president at the G20 meeting in November. It's like his big international economic relations accomplishment, right? And so all of a sudden, everyone is supporting, okay? Everyone is supporting inside the administration and hoping that it'll give us leverage to talk to allies about other economic issues and all of that. But at the same time, now something is really live, which I know we want to talk about, which is until then, like there's a background conversation about whether the old Undertaxed Payments Rule works and how to enforce this agreement so that there are no defectors. But it's not live to decide exactly how all of that should work. Once you have G7 agreement, now it's June, and now it's live. And that's an important thing to talk about.
Yeah, so the original framework, right, the original document that came out, the report, the blueprint, talked about the Undertaxed Payments Rule, right? And then it was changed, we've talked about this on the podcast at length, then it was changed to the Undertaxed Profits Rule. How did that happen? And maybe give a little bit of context, or at least your perspective.
Right, so I think a couple things to say. First of all, it's important to remember, everyone talks about the Undertaxed Payments Rule as if it was radically different than the Undertaxed Profits Rule. It's important to remember the Undertaxed Payments Rule measured the amount of the undertaxed amount by reference to country-by-country profits. What changed was how you enforced that being collected. Yes. What was being measured did not change. And that's really important, and people forget that, okay? Now, then...
But it's also a really meaningful difference.
It's a really meaningful difference in terms of...
collected.
It's really meaningful in terms of whether the rule works.
Yeah.
It's not meaningful in terms of what the rule measures. Okay. And I think that's really important, okay? So what was going on in the background? Like, remember, I've said that Brexit was really important to foreign sovereigns. So bubbling in the background, right, is this idea, especially among EU member states and also some others, right, that like if the UK defects, that's like a real problem. And this is the point where they're still their prime minister is basically saying that's what I want. That's what his rhetoric was just up until then, right? And meanwhile, there's the fact that we're now talking about staking president-level credibility on this deal. And so if tax planners are easily able to plan around this supposed global accomplishment of the president, that's going to be pretty embarrassing, right? And meanwhile, the Treasury is aware, and I have been aware for some time, that in services, not so much in goods, but in services, the old rule is pretty darn easy to plan around, okay? Like, it's not hard, especially if you can invert, but not only if you can invert, okay?
Making it on payments, you mean?
If it's on payments, because you can make sure that like you're basically booking into the jurisdiction that's undertaxed and not sending payments out. We could talk about that for a while, but that means, and we've made that point, and we've shared it with our counterparts, right? And so there's been this quiet discussion going on, basically among the G6 in India, about what we would do if we got agreement, but we haven't finalized what to do. Like, we know that we're not that happy with the undertaxed payments rules, but there's like a softer option and a tougher option, okay? Now, how did we get to the tougher option?
Yeah.
Because that's what we got to.
Right. How did we get to
There were two possible changes, and we got to the tougher one, okay? And the interesting thing is what happens in the private sector. Because the private sector tax world is surprised. They're a little bit paralyzed. But people don't like this idea of a global minimum tax all of a sudden. And so people start to machinate. And via the BRT, there ends up being the story that Pillar 2 is bad because it could help China. And here's the thing. It's like right when we're trying to sort out the new UTPR rule, and we need to go brief the White House on where we are about all of this. And until then, I'm just getting, from NSC and state things like, how can we support you? But this China thing, is it true? They start asking, is it true that this is pro-China because all the Chinese subsidies are in the ultimate parent? And so this won't hit China? And so in some sense, the BRT and the chamber, by saying that this policy was pro-China, put a thumb on the scale to have it hit the UPE jurisdiction. And
the idea being if China's parented group is getting a bunch of incentives and China does not enact Pillar 2, that this would allow a foreign subsidiary of China to collect the top-up tax related to those incentives.
Well, basically,
China.
Basically, like, Chinese would get their incentives, and no one would be collecting on them, and other countries don't give as many incentives, and so we should go after the Chinese, right? Now, meanwhile, understand it's not so long after the American Rescue Plan passed. So NEC is sitting there saying, oh, we're going to get a bill through with a 25% or 28% corporate rate, and we're going to repeal FDII. And so, if you think about the way that U.S. incentives work, especially the R&D incentive, well, if you do the estimates from a 25 or 28% corporate rate, and without FDII, I can tell you the impact of UTPR on U.S. M&Es is not zero, but it is minuscule. It barely hits, right?
And that was one of the questions I had for you. Was there a focus on the R&D credit? Because obviously the UK is refundable, ours is not. There's been a lot written that did the US sort of get penalized because ours is below the line and the UK's is above the line. And the answer is, well, if the rate was at 25 or 28, it just wouldn't have made a meaningful difference.
Well, so I mean, the first thing to realize is a lot of tax practitioners are really focused on the R&D question. You have to understand that from the perspective of the policymakers, this is almost a third-order question, right? And the reason for that is, number one, we're trying to move a bill, right, to pass Build Back Better, and Wyden and Neal are both telling us this will really help, right, to get this deal. Number two, there's a sense that this is a way to restore international economic cooperation, and there are a lot of other things we want to get allies to do that they don't necessarily want to do, and they're really happy that we're on board with this, right? So this stuff is sort of in the weeds. But then separately, we do actually have to go brief on UTPR. UTPR requires a White House meeting. I go to Inticon on this, okay? And it's NSC, and well, it's not Inticon. It wasn't full Inticon. It was NSC, NEC, and the Treasury, okay, on this issue. And it's interesting. I mean, first of all, recognize I have a problem, right? Which is I don't control the estimates. So let's make an important point, which is I don't control the Office of Tax Analysis, okay? And so there's an important question about how much income shifts back to the United States, depending on whether or not you keep FDII, and whether keeping FDII is really important to having income shift back to the United States. I believed it was. Not everyone did. But the other question is, which estimates do you show, right? And meanwhile, NEC is saying, we're going to pass a bill. It's going to have either a 28% rate or a 25% rate, and we're going to repeal FDII. And so if you show those estimates and you show the impact, it's pretty small, okay? And then separately, you have this China issue, which seems really big, and which I don't believe in. I actually think it's not an issue for reasons we could talk about, because I don't think anyone's redomiciling to China is the main point.
I haven't read much about that.
Yeah, right. Like it's just different, right? Like China's not like going to Ireland. China's not like going to the UK. But people take the China issue really seriously. And so between the China issue and this like impact that doesn't look very big if you succeed, the decision is, okay, well, we need the tougher rule. And I'm sent to go choose the tougher rule. And I weigh in then afterwards at our quiet discussions, the behind the scene discussions that exclude the UK for the reason that one of the reasons we need a tough rule is because people are afraid of the UK, right? And say, well, we want the tougher rule. And then everybody else comes along. And that's how we got there.
One of the interesting things is that the way that rule was initially designed was to deny deductions in a particular jurisdiction, right, to the extent that they needed to collect a top-up tax from a parent company or a brother or sister. What's kind of interesting in practice that a number of countries that have implemented the UTPR have not limited it to a denial of deductions, which could theoretically bankrupt a subsidiary without the ability to be able to pay the top-up tax. When you were having those discussions, was there questions about whether, the lawfulness generally of the Undertaxed Profit Rule and whether it was consistent with tax treaties? Were those discussions or part of this?
I think it's important to recognize that in the entire Anglo world, right? So the United States, the UK, all the former Commonwealth countries, treaty overrides are possible under domestic law, and that in the EU, a directive overrides national level member state treaties. So I think that most people in the discussion understood that as a practical matter, it did not matter, okay? Because you had enough enforcement power that if all the countries that were able to do treaty overrides in effect did a treaty override, then the UTPR would have enough enforcement oomph to work, okay? Now at the same time, you were completely correct, right? Like we saw this thing happen where, the documents said that UTPR was, supposed to turn on, starting, this year, not next, right? And South Korea, didn't. I just think, to be honest, the negotiators' English wasn't as good, and so they didn't understand the oral discussion.
There was this concern that they were going to adopt UTPR 1 year earlier than the rest of the world, and all of a sudden Korea would collect the top-up tax.
For the whole world.
For the whole world.
Which, of course, is impossible because it zeroes out.
That made a lot of us very nervous, particularly
but it couldn't happen. It couldn't happen, obviously.
But remember, from an accounting standard, enacted law needs to be recorded in public companies' financial statements, and that was the big concern.
I think that's an important point for when we look into the crystal ball, right? So let's come back to that, because I'm very worried that we will not reach resolution on any of this until financial statements need to reflect things. So we'll get there.
Okay. We only have so much time.
Yeah,
so
I know.
Where I want to go from there, Ty, is the Build Back Better, right? I think many people thought that this was a foregone conclusion with the Democratic-controlled Congress. Talk a little bit about that experience and with when Build Back Better failed and we were not the U.S. did not move to a 28% corporate rate, wasn't country by country GILTI. Talk a little bit of that experience and then how did that impact the discussions and negotiations on Pillar 2?
Well, just remember, it's a roller coaster, right? And by September, it's passed the House, right? But with a 21% rate and a 15% GILTI country by country rate, right? And so things look really good. And remember that it only fails by one vote.
Right.
It's not like it's so at the leaders meeting, okay, the G20 presidents and finance ministers meeting, I go with the president, okay? And it is the international economic policy accomplishment. It has already passed the House. Now we're agreeing at global level, and the next step is to pass the Senate, right? So it seems really positive, okay? And then of course it all crashes.
Yeah.
And by one vote, and that's really complicated. Now the problem is that we're not done with the legislative process. As you'll remember, the Inflation Reduction Act passes in August of 2022. And the Biden administration still thinks we can pass a bill, right? So we need to keep pushing for a bill. We need to keep pushing for other countries to enact, especially because Manchin literally says, well, I don't want us to go first. I want to see other countries go. So now what's the pressure? The pressure is to get other countries to go, so we'll go. Because that's what Manchin's telling us the story is, right? And so it's a roller coaster, but there we are, right? And meanwhile, of course, now we have to keep the Pillar 1 thing going longer and not get hardcore about our Pillar 1 positions, because some countries care more about Pillar 1 than Pillar 2, which was also complicated for us. Yeah, it extended that problem.
So at what point did you all start thinking then about, well, once you knew that country-by-country GILTI wasn't happening, we didn't have a qualifying income inclusion rule in the US, and then I think it was July of 2023 when we ended up with a UTPR safe harbor for the US that is much now talked about.
Well, look, I mean, it's complicated, right? So just to be clear, I mean, for a while, right, we thought that what we were doing was, producing a common level of tax where we were going to go to GILTI country by country, and thereby delivering on the level playing field that US MNEs have been asking for forever, right? And meanwhile, we were getting 4 years of DST rope-a-dope, basically, is the truth, right? Now, all of a sudden, we can see, right, that we don't have a bill, and we don't have the legislative requirement of trying to help support a bill. So now we need to defend the U.S. Legislation as it is, right? And so we go out and we start saying, like, look, we need time to make this happen. And it's pretty clear, right, because of how Congress was, right, that nothing was going to happen in the 2024 Congress, right? And meanwhile, as we know, the TCJA, is just expiring at the end of 25, and that's an action-forcing event, and everyone knows it's an action-forcing event. And it's not hard to explain to the rest of the world that that's an action-forcing event, okay? And we don't have a crystal ball, so we don't know the outcome of the 2024 election, right? Let's be clear. Now you do, but we didn't back then, okay? And it's a reasonable assumption, although it turns out to be wrong, for Democrats and for us to be saying, well, we don't know exactly what it'll be, but Dems will have some power. We don't know if they'll hold the presidency, we don't know if they'll hold one chamber, but they'll hold something, right? And so we're saying we'll get a bill done in any situation where if you guys go forward, we'll get a bill done in the end of 2025. Meanwhile, the rest of the world's position is, because remember, as part of this whole discussion, Mike Williams has been reminding everyone that in the Trump years, they did these analyses about GILTI on a blended basis versus country by country. And the OECD basically came to this conclusion that said, look, like, a blended tax at 15% is sort of equivalent, roughly, kind of, to 11% on a country-by-country basis. It's like a 4 percentage point difference, okay? So everyone knows that, therefore, no one wants to exempt the US forever, and no one wants to exempt the US UPE forever either, because they're taking on the responsibility of raising their own rates in their own UPEs, right? So we want an extension. They don't want the extension to go forever, right? We want to protect current law. They don't. And so what's the compromise? The compromise, and we don't have that much, we don't have that much leverage anymore, right? Is, okay, we'll extend this UPE safe harbor until when you guys say that you will next have an opportunity to realistically pass a bill, which means the end of 2025. Okay. And that's how we get to that result.
And you say extend the UPE safe harbor, are you talking just
or create the UPE safe harbor.
Create it. Okay.
Create it, not extend it. Create it. Create the UPE safe harbor, sorry. Now we're already into the comment. Even I, right, get a little turned around about the chronology, and it's easy for listeners to have that
I didn't
happen.
mean to be critical. Frankly, the UTPR is a year later than the income inclusion rule, so it was already a year later.
It was already
and now
a delay.
We're just delaying
and we're
it
pushing
a
it
second
further,
year.
right?
Exactly.
We're pushing it further and trying to create space for the U.S. to enact. But we're doing it before we know the results of the U.S. political election, because we need to get it done, right? We need to get it done. Yeah.
So I want to get to the crystal ball, but maybe before we do that, I would love your views on the inclusive framework process, how that worked sort of in retrospect, and maybe where that's heading insofar as, obviously a lot of uncertainty. I'm going to ask you to look into your crystal ball, but really just interested, and I know you spoke about this at the Vogel lecture in Vienna, and maybe just a couple of minutes on sort of the process and how the globe can work together to really try to pick up the pieces from Pillar 2, sort of where it sits today.
Well, let me just back up from that, because I think, look, I've been saying, like, Pillar 2 can level the playing field and gets us closer to a level playing field than ever before. And there's truth to that, right? But on the much more important point, right, the one about helping stabilize the international economic order, the one that, in my view is that order underpins USM&E success, right? Having it be easy to engage in cross-border trade and cross-border business, having an assumption that we're supposed to behave non-discriminatorily towards companies headquartered in different jurisdictions. All of that's like really important to USM&E growth, right? And the goal of Pillar 2 from the non-tax people's perspective was to like help sustain that. Well, that's all gone, right? Like the Trump administration, I mean, we said before, when we talked in February, I said, like, I think they're in the process of shredding the order. Now I think I can say they've shredded the order. Yeah. Okay, it's gone. So that's important because, like, look, I mean, if you were opposed to Pillar 2, what did you think would happen if Republicans won across the board? Did you think we'd go back to 2007? Like, no, guys, that's not where we are, right? Instead, what we have is a lot of the features of the post-World War II order being eviscerated, starting with a divorce with Europe and Canada, and not just China, in trade and beyond. And eventually there's going to be a real price for USM&Es in connection with that, but the original price is sort of paid by the OECD, right? So, I mean, that's why I say this, right? Because for the OECD, look, I mean, you saw this statement come out of the Inclusive Framework just like a few days ago, I don't remember. But it basically said, look, what do we agree on after their meeting in South Africa? You know what it says? It says, we agree to talk. That's what it says. It says we agree to keep talking.
There weren't a lot of details.
What does that mean? What does that mean?
Details.
It means we agree on nothing else, right? And it's true that I used to say, right, that what should happen, because we've proven that Pillar 2 is now effectively an OECD member state project ex-US, right? In other words, most non-US OECD member states have adopted Pillar 2, okay? But most non-OECD member states have at most adopted a QDMTT. They have done almost nothing else. So what I had been saying before is, look, the OECD should go back to its origins as a member state organization, and they should solve this Pillar 2 thing by themselves, and they should let the UN talk about Pillar 1 and just ignore that, and they should like try to do the developed economies again together and get them to all get along. Well, it's really hard to keep that message once you have a 10% across the board tariff and no differentiation between OECD member states and non-OECD member states. And frankly, like, I just imagine the position of my counterparts, my former counterparts. And like, I mean, I was really lucky in my job. I had a really tight relationship with my Secretary of the Treasury. I knew that what I could say and couldn't say, and that I spoke for her when I spoke, and I had a lot of confidence that I could bring her along. These people, even if they had a mandate to negotiate some deal on Pillar 2 before April 2nd, there's no way they believed when they went to South Africa that they had a mandate anymore, right? Because Donald Trump did something so aggressive with respect to their countries that they didn't know where their finance ministers were, and there was huge uncertainty, and they probably had no authority to talk about anything. And my own view is that they won't have any authority to talk about anything until the trade tensions are resolved, because it's just such a much bigger issue than this Pillar 2 stuff. And the Pillar 2 stuff, to the extent that we have retaliatory threats in the Smith bill, right, will just get thrown into the pot with the trade stuff, okay? And separately, I also think from the perspective of the OECD, it's very hard to understand why, when you have this kind of posture towards the historic, I don't know, like gist of the OECD, which actually in some sense was about like open trade and cross-border investment, at least among the developed countries. Like, why do you focus on getting the US and the developed countries? You sort of start thinking, well, the US is kind of like an outlier now. We got to keep this inclusive framework thing going. So I had a view, which I felt very strongly about until April 2. And now I sort of understand why the OECD people would say to me, Itai, that's a lovely view in a different world that we don't have. I think that's what they'd say.
So what is your view of the prospect of the OECD granting the U.S. sort of a permanent UTPR safe harbor? And then the other thing that was in that first Trump executive order was, he made the comment about the UTPR shouldn't apply to foreign subsidiaries of U.S. multinationals, which sort of begs the question of, well, could the OECD find GILTI in its current form to be qualifying to effectively turn off the UTPR?
I think there are two alternative worlds, right? I mean, I think there's this world that I wanted to believe in until April 2, where international economic relationships were calm enough that tax could be dealt with in a silo, okay? And there you had Commissioner Hekstra and some finance ministers indicate that a UPE exception for US M&Es in the form of a multi-year extension, probably not permanent, but like an extension, right, to get us pretty far down the road, right, was on offer. But that was dependent on two things, right? One was the Congress not taking a maximalist position about Pillar 2. And what I mean by that is if you look at 899, right, it basically says that even if you exempted US M&Es completely from Pillar 2, as long as other countries kept the rule just to worry about whether or not, Singapore is cheating on the global minimum tax or Switzerland is or whomever else, right, that retaliation would still apply. And that's just like a non-starter for these countries. Like Europe needs an enforcement rule for UTPR, even if they don't have to worry primarily about the US because they're not so worried that people want to invert here, okay?
I mean, that legislative text is just proposed, right?
Yeah.
It was very much intended to go after the UTPRs and DST. So, but I will acknowledge that language is a bit soft insofar.
That language is really broad, right? It says if there is if there's any DST, and just to be clear, Commissioner von der Leyen literally just said, if you don't give us an equal deal on tariffs. So if you want 10%, we impose 10%. If you want 0, then we'll do 0, is basically what she was saying. Not quite. It wasn't that detailed. Then the next thing we should look at is a European-wide DST. Let's be clear. That's where our biggest trading partner is, okay? And the EU as a whole is our, China, Canada, and Mexico, sure. But do the EU as a whole and see what the numbers come out to, right? So that's a big problem. And then separately, you've got the issue that you've got 899 and you've got a trade fight, and so until all those things are resolved, I don't know how this settlement it seemed on offer when we spoke in February. I mean, I really believed there was a deal that was on offer that in some sense gave US M&Es the best of all possible worlds. They'd wanted a level playing field, they were going to get an even better than a level playing field.
To give them a UTPR safe harbor.
A UTPR safe harbor that other countries can't have. Wow, that's unbelievable, right? What a boondoggle. You got the level playing field and more, okay? But now I actually think that's kind of gone, and I think you should have seen that coming in some sense. In other words, it's not as if the Trump campaign wasn't clear. I mean, it's just doing what it said it was going to do. There's nothing about what's happening that is not consistent with what the president said he wanted to do in international economics. And the problem with it, as I've said in multiple forums, is for multinational enterprises that have double-digit year-on-year revenue growth, having an environment that's conducive to international economic growth is just much more important than a couple points on an effective tax rate. And that's where we are. And so there are a bunch of people who wanted this result. They wanted, Republicans to be in power so they could kill Pillar 2, and now they're getting what they wanted, and it's going to be bad for M&Es.
So we're at about a time here.
I'm sad about it.
And uncertainty is the enemy of M&Es, right? And we're certainly in an uncertain point. But maybe just as a final question, anything else that you would like to add, or I do have maybe one last question, and I'll also let you add anything that you haven't. Now looking back at your time in this role, would you do anything different? Is there anything part of that experience that you would go back or you've thought to yourself and said, man, I'd like to have another at bat at some point?
Everybody, in terms of me, you got to understand, for a year, there was a period where it was so, I talked to every country in the world, literally. I got emails from state and treasury from around the world, all the US, all the treasury reps all over and all the embassies. I basically slept 3 hours at a time and no more than 3 hours of time every weekday. So there are plenty of things I
Working the
regret
clock,
because
you're
there was
saying,
no, so that I have regrets, of course, because you can't be perfect, right?
No.
But am I proud of what we did given what we knew at the various times that we knew it? Yes, I am. In terms of things I still wanted to say, I mean, I honestly wish people could understand like how hard I and dozens of other people worked, okay, to try to fix the lack of trust that had existed after the first Trump term and how much effort that took. And I think people need to understand how hard it will be to make that happen again. And then I honestly, at the end of this term, and I honestly want to warn heads of tax and above, to think seriously at this point about, letting their trade groups take strong anti-UTPR positions in the context of this trade fight where there are just so many bigger issues. I'm not sure it's going to help that much. I think you want like a settlement that is like a calm, everyone can live with it settlement. That's the best opportunity. And separately, I think that companies should try to get good advice about how to message to places like DG Tax and Trade in the EU and key foreign sovereigns if they think that they are not the problem, but they could be viewed as leverage, because I think that's coming. But again, that's like a worst case. Like I can't express how sad I am about where we may be headed. I'm devastated by it because I believe in US M&Es and I believe that they provide better jobs for future generations of Americans than either, or more of them, than either foreign headquartered M&Es or, other industries in the country. And so I'm really sad about where we're going. I do not think like this is great. I think that the markets are telling us at some level lately, hey, we trust US M&Es more than we trust the US government. That's why stocks are going up and treasuries are going down. And that's good in one sense, but only relatively good, right? Like, it can't be good for growth if people aren't trusting the US or don't feel like the US is their friend. Like, I'm worried about that. I'm afraid.
Well, Itai, I'm sorry to leave on a sad note and afraid note, but first of all, I really appreciate you coming in. I think this will hopefully be very insightful for listeners to understand your perspective and sort of relive that experience and sort of how, and I really do think it adds some color to the discussion of how we got here, how the U.S. got to where it is in the current discussions and position with respect to Pillar 2. So, and I also really appreciate you coming back here into the studio and re-recording this. So thank you very much.
So thank you, Doug. I'm sorry we had to do it twice. I hope, for anybody who wants, we'll find you the old one, and you can decide which one was better. It doesn't sound as good.
Oh, it sounds terrible. But again, thank you very much.
Thank you.
I really appreciate it.
All right. Thanks, everybody.
Thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Professor Itai Grinberg, Georgetown University Law Center professor. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.